Hi, I'm Peter Lundgren, founding CEO at Lundgren's Capital.
And I'm Mel Lopez, Chief Economist for ASEAN.
Welcome to Sound Economies with Mel and Peter, an East meets West podcast by Lundgren's Investor Insights. Here we share what we're focusing at in economies and financial markets from the developed and the developing world. Hi Mel, how are you doing today in how's life in Manila?
Hi, Peter. So, just counting down the days till Christmas. It's very holiday vibes here in Manila. But we've had a few things move along in our work here. We just today published an article about Malaysia's global value chain participation. So that's very exciting. That's on the Longines Investor Insights website. Peter, how are you?
I'm fine. We are, as it is in December ahead of Christmas and the holiday season, sort of in this very busy mode with truckloads of things we have to do simply and having actually good investor activity.
Mhm.
People come for investor meetings, conversations. This week we announced our new investment in our fund, our defense fund. That was investment allocation number 7 this year. Very
Right.
interesting. Yeah, it's actually it's really powering ahead. So truckloads of things, but it's good things. We're happy, and then actually close the company today on this Thursday, and then return after New Year. Still, we have funds that are, of course, we need to look into every day. We have also listed funds, our China fund. A lot of things can happen there, and we are still as basically open for our investors and for conversations every day. Also Christmas Eve, Christmas Day, New Year's Eve, New Year's Day, whatever, and we do have conversations, but basically sort of more official. It's last day today in the company this year. That's always a good day, yeah. That is also going on. Okay, but anyway, apart from talking about having holiday, we of course need to look into the exciting financial markets that never sleeps, and
Yes.
London never sleeps either. For 100%, we are there. Today we will come across the Honda and Nissan sort of merger that's planned in Japan, the two automotive companies. We will, of course, spend some time on the Fed rate decision, not the decision itself, the comments, the outlook. Is it a surprise what they're saying? Let's look into that. China is interesting after last week's meeting, and then the outlook for whatever U.S. tariffs in the new year. And in Germany, the election campaign is now official, and of course, we need to look into all the good things that the parties are proposing for the country and the people. And as always, we end up with our global outlook to see how much the sun is shining. But Emil, let's jump into Japan and the Honda and Nissan merger. Quite interesting.
Yeah, Peter. So, local media is reporting that Honda and Nissan are starting merger discussions. This comes months after they've started collaborating closely with like products and research. So, this comes in the face of the huge threat of Chinese EVs outpacing the
Mm.
auto market globally. So, this is interesting to me because these are the top two and top three automakers in Japan. So Honda is top two, Nissan is top three. And
Mm.
they're trying to catch up with the EV race, basically, and car
Yeah.
development. They are, and it's also bigger actually when we look at it deeper because they also involve Mitsubishi and Renault as strategic investors. So it's basically more than just two Japanese brands merging.
Yeah.
And I find it unique because the response to the China and Tesla EV race is different in the other side of the world. So in Europe, for example, European brands are going into factory closures, reducing their operations or their sites just to, save money. And here you
Mm.
have two mega brands who are putting their minds and resources together to try to catch up with the race. So
Yeah.
it's also in the face of higher tariffs, maybe, in terms of EVs and anything
Mm.
China made as far as the US economy is concerned. So it could be a strategic move also to how do we capitalize on that and maybe race ahead in terms of production and development. So
Yeah.
it's a very interesting move, and it's believed that it could be going along faster than expected. Although I did read just before coming into our podcast today that Foxconn is trying to enter the picture with another investment proposal. So
Oh,
that's an interesting development to monitor in the coming weeks, Peter.
yeah. For Foxconn, that is a bit. That's basically a smart mobile
Yeah,
assembly
parts.
company. Yeah, yeah,
From mobile parts to possibly cars. So that's also a
yeah,
very interesting move if it materializes.
yeah. But the thing as happening in Japan with Honda, Nissan, and even the border perspective is also it is so interesting because as the car automotive market, the car market is changing completely. Yeah, and if it
Yeah.
succeeds on the Japanese getting this Japanese powerhouse, the Asia region is
Hmm.
taking over even sort of more dominance in the electric vehicle EV market and completely outpowering Europe.
Right.
And it is as a you should also consider it is within a few years just. It's a very short time that these enormous changes are happening. This is really interesting to see if it succeeds to get this Japanese EV powerhouse. Let's see what happens in the coming months there. Good. Otherwise, we had the U.S. Central Bank acting again with a rate cut, absolute as expected.
Hmm.
It is the most professional central bank in the world. They're fantastic in communicating with the financial markets. And even, I think, last year, they basically said they will cut 3 times this year. And it was in the second half of this year, and it's actually what they have done. So,
Right.
in that terms, as a 10 out of 10, yeah,
Mhm.
in the rating of central bank. What was interesting was the comments. And now they are signalizing that where sort of, I would say, predominantly in the market, there was an expectation about further 3 rate cuts next year. It was also a bit what they have maybe signalized themselves on the long term outlook. But now there's a clear signal that it might just be 1 rate cut. Um, that is actually how the market already has changed and contracted, and it is now sort of like
Mhm.
just 1 cut expectation. And that is in itself interesting. It also adds a bit on what you and we've sort of been talking about, that the tailwind for the stock market is not as strong as originally expected, and the tailwind originating from this rate cut environment. That was basically one of the biggest changes in our outlook when after the presidential election in US, and also the reason why we said, okay, we cut our sort of where we like to be in the fixed income market from a very long duration to more midterm duration for the bond portfolio. So this is happening now, and it's just adding another small piece of end of tailwind for the stock market, US stock market, global stock market. And we know that it's not making a big change for us right now. We just see it is happening, and that makes sort of these clouds on the horizon we are talking about again a
Mhm.
bit more clear. Some would argue, hey, the European Central Bank will cut rates ongoingly. Talk in Europe that they will simply slash the rates to very low to support the economy. And there I would say, wow, that's a speculation, because the European Central Bank is here for fighting inflation and only that, as
Mhm.
apart from printing money and doing some practical stuff. But they have one duty in life, and that is to keep inflation
Right.
below 2, but close to 2%. And inflation is maybe ticking a bit up again. And that is also what the Fed is sort of afraid of, that
Yeah.
inflation might be ticking up next year. And if we look into the financial markets, sort of across asset classes, we argue that nowhere is a high inflation next year priced in. It's not in the fixed income market, and certainly not in the stock market. So that is an upside risk that as the inflation goes up, that would sort of that would be negative for the financial markets next year.
Mhm.
And it would also be difficult for the European Central Bank just to cut rates. They could be seen as simply ignoring reality. And together with debt problems outspoken
Yeah.
in France, sort of growth problems in Germany, and general problems here and there, that could make international investors even more nervous about Europe. So ECB has a difficult job now if inflation is
Going
making
up.
just a slight pressure. Yeah. So this is all interesting. So the isolated rate cut yesterday was expected, fantastic, but the changes that Fed are that could have a global impact is how we see that one, and should not be neglected. Important small piece of information.
Stocks
Anyway,
were right,
yeah.
Peter? Like I saw that the US stock markets were like down 3.5% after the Fed decision. And I was kind
Mhm.
of surprised because I thought everyone expected the 25 basis point cut. But
Yeah,
apparently they were reacting to the uh Chairman Powell's
yeah,
statement that basically higher for longer rates will persist in 2025 versus what they previously expected. So yeah,
yeah,
you're right. Higher inflation isn't really anticipated or priced in for next year. So that's where the surprise is coming from.
for sure. We have an eye on it. We have talked a bit about it for, I think, some
Mhm.
podcasts ago, that it seems that cost pressure here and there is ticking up. It's not outspoken in Europe, it's more outspoken in the US. Yeah. As a producer prices are clearly higher. And we see a lot of price increases in the business sector. So we actually have an eye on that one. Anyway, let's jump on. Another big player in the global economy, China.
Yes.
Mel?
So last week, the Chinese executives from the CCP met for their economic work conference. So that's kind of like their tone setting for 2025. And it was led by President Xi Jinping, where he said that their priority next year is to vigorously boost consumption. So by that, he means higher government spending, and they're um, more tolerant of a wider budget deficit. So that's what they'll do mainly to improve or to raise GDP growth, because they're sticking to the 5% annual growth target, but they're just under that so far. So for 2024, the 5% is the target. They're at 4.8 as of September. So still some push needed to really hit that right nice round number. They're
Mhm.
also looking at looser monetary policy, reduced reserve requirement ratios, and even tolerant of increased debt issuances, just to stimulate the domestic economy in the face of their ongoing property slump. And of course, everyone's really spoke about this um, tariffs from the US economy, which
Yeah.
is supposed to come in by January. So I think this is they're bracing for impact basically. So these are
Mhm.
broad strokes from the Communist Party, but everything like the details we're yet to find out, because it will be up to their Congress to like put in the money, put it in a budget form to make it happen. So but the question here would always be, can China's fiscal position handle it? So if it
Mhm.
comes by way of additional public spending, it means you incur more debt. Or
Mhm.
if you provide cash subsidies, it means you have to spend more. And
Yeah.
where would you finance that? So the public debt level in China is not as bad as maybe the European counterparts. It's not
Mhm.
100+% of GDP, but it is at an all-time high of 83%. So it's a bit a cause of concern, if you will.
Yeah.
But at the same time, it's the response that they might just need, that they need to focus on domestic growth now that
Mm.
there's increased volatility externally. Trump is really a big wild card as far as China's concerned. And if he does impose additional tariffs on his first day on January 20, so
Mm.
that's gonna be a rough road ahead for China. So it is good to look inward and drive growth from there. But it hasn't really picked up yet. We're seeing very low inflation. We're seeing deflation as far as producer prices are concerned. Business
Mm.
and consumer confidence is far from its peaks from like 5, 10 years ago. So they have a
Yeah.
long way to go to really perk up the domestic sources of growth. And to do
Yeah.
that, it would be quite costly. So
Yeah,
yeah,
you're right.
that's a
Yeah. And as you say, as a compared to the stand many other countries, it's not alarming, yeah, but it is at a stage where they are losing fiscal maneuver room.
yes.
That should not be underestimated. Last week, I believe it was, we talked a bit about this very long discussed boost for for the consumption in China, where as we agree since several years that it is the domestic consumption, the household consumption that needs to change the game for the Chinese growth. But we have also argued that we don't think it's likely. It's simply not. We couldn't see it being in the cards within the political leadership in China. But now we did touch last week, and maybe we could see it the chances a bit higher when we come into a new year, and that is. Of course, in respect of what will happen when US attacks with all the higher tariffs, it's hardly to imagine that the Chinese government will do anything before that. But do we still see also after last week's meeting that could we even now here long range imagine that there will be sort of a consumer growth package next year? Is the likelihood growing?
Well, the stimulus packages from late, just a few months ago, I don't
Mhm.
think that has been, completely rolled out yet. So I
Mhm.
think they'll take it a bit slow in the sense that they'll wait for this recent stimulus package to unroll and to be felt into the real economy before they consider adding another one, because it is gonna be costly. That was already 10 trillion yuan, right?
Uh,
So they also have that excuse that, oh, we'll wait and see how the Trump situation will really go before they decide on anything. So
uh,
I don't think it's gonna be immediate.
Interesting. Good. We need to be patient then. And then in between, we can turn the focus to an even more troubled economy. That is Germany, and
Yeah.
the biggest economy in Europe, one of the biggest in the world. Now is I would say also a world famous zero growth economy, and it is the truth. It's actually slight negative, so they are in a sort of a ongoing recession. It's not a lot, sort of minus point one or something. But we should imagine that that is an average number. Yeah. So there's a lot of households or a lot of companies, a lot of whatever in Germany. They feel even more negative growth. Some feel more positive growth, but the key is if some are feeling a growth rate of, let's say, zero point 0.2, that is
Mhm,
simply not enough to cheer people. That is like being in a sort of zero situation.
mhm,
So people are more in a even, but when we look at it, we consider it as a more negative growth uh, situation than just a slight minus zero point 0.1 or
mhm.
zero. The high end of the range when calculating the average is not really feeling anything good. Yeah, it is spreading. So the negative scenario is actually more spreading than being stable. This is the way we see Germany. If we look into a lot of details, we listen to what people are saying, what the mid cap sector is saying in the industries, and of course everything linked to the automotive industry, as they are feeling a lot of suppliers across Germany. They are really feeling the downscaling of the whole sector, and the automotive sector, not only the car production, but because there are so many suppliers, actually means a lot for the German economy. It's a big thing that we are seeing. So it shouldn't be that development alone shouldn't be neglected, and it actually sort of underscores the problems that Germany are facing and have been facing for a long time. Back when the COVID-19 broke out, we were arguing that in that quarter, Germany would actually have hit around zero growth.
Mm-hmm.
But since then, it has been hidden with as a COVID-19 sort of economic countermeasures, then high inflation countermeasures, and that has pumped a lot of money out in the system, but it has not changed the economy. And it has increased the debt and without really reforming the economy. And the economy needed reforms also before that. So it's sort of like it is actually a sort of 15 to 20-year problem
Yeah.
that the German economy has not been reformed really, and the economy is now suffering from that. So that is our basic standing on Germany, and that is nothing new, and it's almost sort of to repeat myself. But anyway, so it's been so interesting to see what the different parties has proposed now. As this week, German government lost the seat. Basically, that was all programmed and all expected. But the election campaign is now officially going on, and
Mm-hmm.
the election will be on the 23rd of February. That was also known beforehand, but the different parties has presented this week officially what they will propose for Germany, for the German economy, for people, and honestly, we actually talked about before the podcast here. Do we even want to cover it? It is so boring, and it is so much without a new incentive that it is a catastrophe. Let's be honest. First of all, Germany is looking into election year next year, and it means that there won't be formed a new government before in April. They're very slow in doing so typically. So the political part of Germany is not working almost the whole next half year.
Next year. Yeah.
And it is a catastrophe for Europe's biggest economy. It's not allowed to happen. If we look into the different suggestions from different parties, very much as expected, depending on where they are on sort of right wing, left wing, they want to play around with the income tax, with the taxation of companies. The more liberal parties, they want to lower the taxations for companies, and they want to also actually reduce some taxes for wealthy people. And if you move a bit towards the left, you will see a higher taxation of the wealthy people and a lower taxation of the low income households. But we are talking about small adjustments. If you look into the whole economy, the whole German economy, these are small adjustments. It won't change anything. Then the electricity, as sort of the energy prices, is up for discussion all the time in Germany. And the reason why they are was actually because the energy prices for businesses, particularly for the industrial sector, manufacturing sector in Germany, was subsidized by the cheap gas from Putin before he attacked Ukraine. So, and German industry, German business sector is still suffering from the jump in energy prices. So these are kind of discussions, and then the third leg is sort of public-like investments to boost the economy a bit. As there's simply nothing new, and it won't help the economy. Germany should sink in reforming 25% of the total fiscal budget if they want to move forward. 25% of the whole budget.
That's quite
And they
big.
should, that is enormous, but that can describe how big the reforms need to be to move Germany ahead. And they should look into Greece and see what is happening there in the labor market. We have told about it before, that the labor working hour time now is 44 hours per week in Greece, with 6 days of working week for some sectors, not for all. We expected it to end somewhere in that everybody will work maybe 41, 42 hours per week. That will mean a lot for Germany. Moving away from the dream about somewhere 35 to whatever, maybe 36 hours. That would change a lot for the overall income in the German economy. These kind of discussions are needed. No German politicians dare to do so. And what is the consequence? From an investment perspective, our judgment is it is in the future just as much uninteresting economy as it is today. And when we have this tough economic environment, it is also tough for investors to search that way. No reason we will after the German election not change our outlook on the way to Europe, particularly Eurozone. And that is actually the conclusion after I've seen the what the different parties they offer. And that is of course not,
That's
not
very
particular.
grim.
Yeah, that is not particularly happy to talk about, but that is simply how we see the reality. Yeah,
That's fair.
Mel. So I think we will look more as always in your direction and in the US direction.
Right. So Asia is our favorite spot to be right now, despite the challenges that we see
Yeah.
coming into 2025, tariffs targeting China, any move to lift domestic, look inward and boost domestic consumption will be very helpful. And that's definitely still better than the situation in Germany, for example. So,
Oh yeah.
yeah.
Yeah. Let's round off with the global outlook. Where are we in your end? You have almost disclosed it, but what do you think?
Yeah, I got ahead of myself, but we are very upbeat towards Asia, as we always are. So it's really where activity is upbeat and robust. Europe, it's not like Europe where it's zero growth. So some economies, like China, for example, is facing some headwinds domestically, and of course the tariff threat.
Mhm.
But about 5% growth is very much respectable, and that's positive for investments as far as taking positions is concerned, Peter.
Yeah, we like high growth and we like size here in the company. Yeah.
Yeah.
So this is where it needs to be. Yeah. Despite the clouds we've talked about today, as we still see a lot of sunshine in the market, we like to overweight risk. We like to have, as you mentioned, Asia, emerging markets, overweight US, underweight Europe. Again, on the fixed income, a bit more mid-duration. That has not changed. We are, as also talked about this podcast, we are seeing just all these small growing number of stress factors for the global financial markets. They are mounting. It's not a lot, and it's not enough for us to change the view. They are on the horizon. The clouds are growing a bit, but we're still talking about maybe 6 to 9 months ahead, and things will happen. Things we don't know about today will happen in between, and they can go both directions. They can sort of make the outlook worse, or they can actually help the outlook. That we don't know. So we remain sort of pretty happy, also going into the new year. So that's basically it from us today.
Thank you, Peter, and thanks everyone. We at Lundin's Capital wish you a happy holidays. We'll be back with our podcast episode in January. Please watch out. We'll be coming out with a video podcast this time. So thank you.
Yeah, that will be very different next time. Looking forward to that one.
Thanks, Peter.
We will be monitoring global developments and will share what's interesting in the next episode of Sound Economies, Mel and Peter on the Global Financial Markets, a podcast by Lundgren's Investor Insights. Thanks for tuning in. For expert insights on the go, download the Lundgren's Investor Insights app for free. For investors, we offer very exciting and high quality alternative investment funds, including our top-rated mutual China fund. To know more, visit lundgrenscapital.com.